I'm speaking with Jonas Palmqvist, co-founder, Alphinity Investment Management. First of all, Jonas, thank you very much for participating in the Inside Network's Equities and Growth Symposium 2025.
Thank you for having me. Great event.
A great pleasure to have you. Jonas, asking all the fund managers this question in a couple of weeks where we've seen very dramatic downturns in the indices. How are you positioning your portfolios, and is this the kind of time that active managers crave?
Yeah, I think the outcome on the other side of it all will be, having said that, I think it's one of those times where you're less probable to get it right in the short term because the moves are huge in so many markets. But we're kind of approaching it with a bit of one foot on the gas and one on the brake, because these situations throw up opportunities as well as new risks. And on the risk side, obviously, anything too close to this tariff mayhem, you have to reassess. But on the opposite side, I think a lot of stocks have been thrown out, babies have been thrown out with the bathwater here, and that's creating opportunities to lean forward into. And then you can get the timing roughly right and set up the next great performance period in these episodes.
Everyone would assume that for active managers, your menu or your watch list, all of a sudden, all of the froth of several years can come out of the share price, and it's great times to buy them. But are you saying that overall the risk has to be taken into account holistically, and it's not just a matter of stocks you've been looking at suddenly being a lot cheaper?
It's a bit of a mix, but if we find a company where it's reasonably insulated from the worst tariff risk, and at the same time we see a valuation we haven't seen for a couple of years, that makes us lean forward at this point. The markets are down a fair bit with really big volume as well backing it. But in other instances, that valuation discipline has to work the other way, because you have companies where the earnings outlook has gone from positive in January to quite unknown and negative now. And there you're not going to get much help from a valuation approach. You rather have to examine the actual earnings risk and not be tricked into a low valuation. But there are a number of stocks now that have that insulation, and earnings are probably going to be relatively fine. So that's an opportunity.
With market leadership, it was starting to broaden away from the mega caps, and then the latest turmoil in the markets hit. But what qualities are you focusing on to find the next generation of global equity leaders, post, of course, the turmoil?
No, it's interesting because the big Mag 7 stocks, as they're called, they already started losing that leadership in markets and earnings revisions, etc., before Trump. So it's less Trump-driven. So in our investment process, they actually were falling into a more negative space back in the fourth quarter of last year. So leadership is broadening, and it's broadening in multiple dimensions, and it's broadening a bit faster than we expected. So it's going into the rest of the market. So you have another 493 stocks in the S&P 500 that are looking quite interesting from that perspective. And you also have more early stage recovery stories in Europe and partly in Asia as well. So what we're looking for right now, we're looking very broadly, and we're looking for those characteristics where less impacted by the uncertainty around tariffs, but also some kind of low expectation by the rest of the market. And it's really a quilt across a number of different regions and sectors that we're looking quite sharply at.
So how are you balancing valuation discipline with looking for earnings growth in what potentially could be a market that's gone through an inflection point?
Yeah, so it really comes back to, I think, two dimensions on valuation. Now, it's going to help you because of these stocks that are now hitting valuations we haven't seen for a couple of years. If it's backed by quality and some insulation from tariffs, that's probably where valuation discipline is going to be in your favor. And I actually think that quality piece, be it in more of a defensive business model or more lean forward growth business model, quality is probably going to come to the fore here in the market. Not least balance sheet quality. To have a pristine balance sheet at some point could be a decisive factor. Valuation is not going to help you everywhere in the market. A lot of stocks are going to look cheap, but for a reason. But in that quality end, where you feel like you can touch and feel the earnings case and it's reasonably safe, I think that's where you want to lean forward now.
What about philosophically, when you're looking for the most compelling international equity opportunities, and it might be that the United States, North America becomes overweighted in the portfolio, or is it now a chance to look at other regions, or do regional biases that appear from time to time in the portfolio not worry you?
Right now we're very balanced actually between regions, but recently that's been through adding a few European new ideas, and it's quite broad. There are some reasonably defensive consumer cases that we think have turned a corner and are looking quite attractive on valuation. There's a financial stock, there's a healthcare stock, so there's a bit more interest from us now in Europe and even in Asia as we move forward now. In the US, it's a real bifurcation. It's money out of the Magnificent Seven, which started before Donald Trump, and then finding those more idiosyncratic stories that are now a little bit on a discount valuation as we see it, and probably more protected from the chaos around tariffs.
You spend a lot of time identifying those idiosyncratic opportunities. Once you've gone in, what's Alphinity's generally preferred or expected time frame for your investment thesis to pan out?
Yeah, so it actually differs from case to case. So you have some stocks that we have a very particular process. We look for a gap between the market's earnings expectations for a company and the reality that we think is going to play out. And when that gap gets a bit bigger than normal, there's more upside to the market's expectations than you see in other parts of the market. That's when we get really interested. So in one sector like technology, that could mean a 4, 5, 6 year period where the market's chasing the real earnings power of the company, and that stock can sit in the portfolio for multiple years. Then if you switch to the more cyclical side of the market and economies like banks, the shelf life of an investment case where there's an earnings gap that we think is attractive could be maybe 18 months. So it's really case by case how long these earnings stories last in our process.
Do you find that the decision to sell and selling discipline is equally as important and it takes as much intellectual effort to work out as the decision to actually buy?
Yeah, and selling is actually, I think, the tricky part of investing, because normally, your winners can run further than you think. The earnings power could be even bigger than anyone expected initially. Finding that final point where a case is fully discovered and the company is about to start disappointing the market is tricky. The way we approach that is by trimming stocks where valuations are rising what we think is to excessive levels, but also managing overall portfolio risk from that perspective. So when a stock starts becoming too much of overall portfolio risk, we only have 25 to maybe 35 stocks in the portfolio, so there's a lot of competition for capital. So trimming into that final stage, and we're never almost going to hit the exact top in a stock, but we're big believers in using valuation and portfolio risk as measures to kind of dial back those positions, because what we're trying to achieve is consistency in performance for the portfolio, not just big numbers in all directions.
Jonas Palmqvist from Alphinity Investment Management, thank you very much for your time today.
Thank you. Thanks.